Okay, so in this video, we're covering how to identify trading zones and take profit targets using real chart structure, not theory, just practical price action. We start with an animated chart example that walks through the full process from start to finish. This sets the foundation before we move into real chart scenarios. Step 1 is to find any clear low traffic area, also called an LTA. These are places where price moved cleanly and impulsively, without much resistance. Once we've identified a suitable LTA, we look for a take profit level. Usually that's where price previously paused or consolidated. That's where we expect price to slow down again. Next, we draw the trading zone. It connects the major support with the take profit level. This green zone shows the exact area we're planning to trade into. We also add target levels inside the zone. These act as checkpoints for scaling out. For example, we might take off 50% of the position at the first target, then 75% at the second. The rest can run to the full take profit if price moves smoothly. Now, in this animated setup, we start by marking major support and resistance using the CCC method. Then we wait for price to break below support and begin a clean downside move. To see where price might go next, we look left. Right away, we notice two key clusters of candles. If price enters this zone again, it will likely behave the same and move quickly and cleanly. Once we find our LTA, the next step is to mark a take profit level. We place it just below the zone we expect price to move through. These hesitation zones are ideal for taking profit. They often act as natural stopping points. With the TP in place, we draw the green trading zone. It starts at recent support and ends at the take profit level. Now we've defined the area we plan to trade. Inside that zone, we add target lines. These are based on smaller hesitation points or past choppiness. They give us smart places to scale out, lock in gains, and manage the trade if price slows before hitting full target. For example, we might exit 50% at the first line, 75% at the second, and hold the rest to TP. This method gives the trade space to work, but without relying on a perfect run. Now we move to our first live chart example. In this example, price is trending strongly bullish, and we're positioned near the top of the move. We start by marking support and resistance. That gives us structure to plan around. Next, we look left on the chart as we should always do. We're scanning for low traffic zones that offer clean movement. Here we can spot a bullish LTA, large bodied candles with little to no pullback. That's the zone we want. Just above that LTA is another move, but it's messy. Wicks, overlapping candles. It even starts to form a small head and shoulders like pattern. That zone lacks clarity, so we mark it red and avoid it. Below the LTA, we find a smaller area of low volume. At first it seems tradable, but its placement and surrounding structure make it less ideal. We flag that too. This narrows our focus to the cleanest zone. It reduces confusion and improves probability. We set the take profit at the bottom of the bullish LTA, just before the messy region begins. This TP makes sense. It's a logical stopping point before the noise starts. We draw in the green trading zone, starting from our current price, which sits near major support, down to the take profit line. Within that zone, we add two targets. Both are placed at small hesitation zones from past structure. These targets let us scale out intelligently rather than hoping for the full run. As price plays out, we see it move through the zone cleanly. It reacts at each target level almost perfectly. Then just as it reaches our final TP, price slows down and starts to consolidate. This confirms that it was a high probability rejection area. For demonstration, I want to also show what happens if we place the TP lower and we see price does reach it, but it moves into a lower volume, choppier area, adding more risk. That lower target could still work in a more aggressive setup, but the original zone was safer. Now let's move to the next example, and this chart scenario is trending bearish, but we're expecting a possible reversal to the upside. As always, we begin by marking major support and resistance. Then we scan left for clean momentum. We circle 4 low traffic zones. They're small, but each one shows uninterrupted price movement. These are our reference points. If price enters these zones again, it could travel quickly. To reinforce this, we zoom out and show the pattern we're looking for. Price consolidates with low volume, then breaks. That often signals a shift in momentum. We highlight this behavior with these yellow highlighted zones. They show areas where price paused before trending. This build-up or blocking effect shows when the market is slowing down for a moment and potentially preparing to reverse. As we've talked about before in the candlestick pattern video, minor consolidation indicates change. We map this idea back to the current chart and highlight three similar areas. These help us confirm that the bearish move might be done and a bullish breakout is forming. As price breaks out, we draw a green trading zone extending upward from the breakout area. We set the TP just beyond the last clean area of low traffic. It gives room for price to move, but keeps it within a high probability range. We also mark targets within the zone which are based on past lower highs and rejection areas from the downtrend. They act as checkpoints to scale out as the trade progresses. As price moves, it reacts cleanly to each level. It pauses, then continues upward. This is exactly what we aim to forecast. Midway through the move, we highlight a key consolidation area. It's a small pause that reflects temporary indecision. Spotting these are really important as demonstrated before they signal where price may stall or bounce before continuing. By mapping the zone and layering in targets, we give the trade structure and built-in risk control. We also show a more conservative version of the same setup, a smaller zone with less risk that still works just as well. Now into the final scenario. Price is in a bullish trend, but we expect a reversal downward. For this scenario, like the first, we're looking for price to break below support and keep following its new direction. Looking left, we find two stacked areas of low traffic with a small pause in between. That pause becomes our take profit level, in this case conservatively. It's where we expect price to slow down, or at least mimic its slight pause. We draw the trading zone from current price to that TP line as we did before, nice and simple. This defines our trade range, and inside the zone, we mark targets at previous hesitation points. These help us scale out if momentum stalls. We also point out something important. Sometimes the most useful levels aren't close to current price and visible in recent price history on screen. They're found deeper in the chart's history, meaning when things aren't clear, zoom out, scale back, and look further left. Old structure can offer the best clues, and identifying them by marking with a horizontal ray tool can be enough to make it relevant to the current chart. These deeper levels can act like magnets or barriers. Recognizing them early helps us plan smarter trades. To wrap this up, identifying zones and targets isn't about drawing random lines. It's about understanding structure, spotting clean momentum, and using historical price behavior to guide your trades. This removes guesswork and gives you a repeatable process. It adds clarity, builds confidence, and brings consistency to your trading plan. Master the zones, respect the structure, and let the chart tell the story.